SOXY is the leveraged YieldMax semiconductor ETF, a new approach to capturing high income from one of the most volatile and explosive sectors in the market, semiconductors. The ETF is not to be confused with the Direction Daily Semiconductor Bull 3X shares, which also uses the ticker symbol SOXL. This particular SOXY, under the YieldMax umbrella, uses a synthetic income strategy to mirror the performance of top semiconductor stocks like Nvidia, AMD, and Taiwan Semiconductor, but with an emphasis on generating massive monthly income through option-based tactics. The YieldMax structure does not own the actual shares of these companies. Instead, it replicates their movement using a combination of derivatives, then overlays a covered call overlay to harvest consistent cash flow, regardless of whether the stock price moves up, down, or sideways. This turns volatility into dividends. The goal of SOXY is to provide enhanced yield, often in the double digits, by capitalizing on the wild price swings of semiconductor names without needing to directly own them. To understand SOXY, you first need to understand how a synthetic covered call works. Rather than owning Nvidia or AMD directly, SOXY uses swap contracts and options that simulate owning the stock. Then, the fund sells calls against that exposure to generate premium income. Since semiconductors tend to have high volatility, the option premiums collected are substantial. That means SOXY often yields significantly more than traditional ETFs like QQQ or SMH, but with that reward comes risk. The premiums are not guaranteed. If volatility dries up or the price of the underlying assets crashes and stays flat, income can fall. Moreover, since the fund is synthetic, there's no guarantee of tracking perfect performance or capital appreciation. This is not a buy and hold growth ETF. This is an aggressive income product for traders or investors looking to earn fast monthly cash with the understanding that net asset value erosion is a possibility over the long run. As of today, SOXY has been offering dividend yields in the range of 15% to 25% annually, paid monthly. For example, if the fund distributes an average of 20 cents per share per month, holding 1,000 shares would generate $200 monthly. 10,000 shares would create $2,000 of monthly income. But the actual payout fluctuates based on market conditions and volatility. SOXY is not for everyone. If you're a conservative investor or close to retirement and need guaranteed capital protection, this might be too aggressive. However, if you're an income chaser with risk tolerance and already hold safer positions elsewhere, this ETF can supercharge your portfolio's monthly income. It's also important to consider diversification. SOXY is concentrated around semiconductor performance. If the tech sector weakens, your income and total return could decline sharply. Let's break down the fees. SOXY carries an expense ratio of 0.99%. This is high compared to a traditional ETF like SPY or VOO, which charge around 0.03%. However, for a synthetic income product with active management and derivative exposure, this fee is fairly standard. YieldMax ETFs are actively managed, and that means the managers constantly rebalance the derivatives to maintain effective exposure and maximize call premium generation. The fund's value can be sensitive to how those contracts are managed. This also adds counterparty risk, as derivatives require trust in the other side of the contract fulfilling their obligations. That said, YieldMax has continued launching new funds across multiple sectors, showing growing popularity among income investors and traders alike. Now let's compare SOXY to similar ETFs. Unlike JEPI or JPQ, which own blue-chip stocks and then write calls on indexes, SOXY is more focused and more aggressive. It's even more volatile than QYLD, which writes calls on the NASDAQ. The closest match in terms of structure is YSOX, the YieldMax SOXL ETF, which also targets semiconductor volatility but might be based on a different underlying. For safety, you might pair SOXY with a position in SGOV or a stable dividend ETF like SCHD or DEVO to reduce overall portfolio volatility. Using SOXY as part of a barbell strategy, one side risky, one side stable, can help balance out the risk of NAV erosion. In summary, SOXY is an exciting, high-risk, high-reward ETF that pays you for semiconductor volatility. It is ideal for short-term income, aggressive yield hunters, or as a smaller allocation in a broader income portfolio. If you believe semiconductors will remain volatile and liquid, SOXY will likely continue delivering above-market dividends monthly. But you must monitor your position, consider pairing it with a safer hedge, and be ready to exit if NAV decay accelerates. My meter rating: income gets a 9 out of 10. Risk gets a 9 out of 10, long-term sustainability gets a 5 out of 10, overall portfolio fit gets a 6 out of 10, final score, 7.25 out of 10. If you have any videos you'd like me to cover, say it in the comments below and I will break it down in plain English.